if you're thinking about selling a property or some sort of investment assets in a particular financial year, then you should think about contributing. Lots of people don't think about land taxes. Land tax, they pay property tax deductible. Body corporate fees, it is deductible as well. Borrowing expense is one of the major ones.
The important sort of caveat here is it's not always only for the trust side of things. You can claim GST in your own personal capacity as well. Hello and welcome to another episode of Help Me Buy Property podcast. Today we are going to talk about how to maximize your tax returns, or should I say, how to claim up to X dollars in tax returns, especially when you're talking about property investments. Now, before I invite my guest, a very valued and important guest, I think everyone loves hearing from Sohail, our tax director. Hello, Sohail. How are you today?
Good. How are you? Thanks for having me back again.
Lovely to have you, my friend. Thank you for being part of the Help Me Buy Property podcast. Now, before I go into a lot more detail into the topic itself, let's provide some caveats that this is not to be constituted as tax advice or financial advice or SMSF advice or any sort of particular advice in relation to personal finances that people are facing, because this is the tax season. Of course, everyone would be looking at advice. So always reach out to your own accountant or reach out to Sohail if the need be. Let's kick off. And so what are we going to talk about today? We are going to talk about few key things. We are going to talk about tax returns and what does that really mean. We are going to talk about the common deductions that people usually deduct in relation to property investments out of things. We are going to talk about deductions that are generally not discussed and people are leaving money on the table. And finally, we are going to also talk about the PAYG withholding variations, where you can actually increase the cash flow, especially in the times like today. So without further delay, Sohail.
Hey, so yeah, let's see what the tax refund is. Let's understand that. When the new season starts, every time the new financial year starts, people come from first week of July, and asking for that, please lodge our tax returns because we are expecting a refund of that much or that sort. What is actually a refund? Basically, if you are already you on a PAYG income, your employer is deducting some tax at source, okay? But at the year end, there's a reconciliation of that tax you already paid to tax office through your employer, okay? So what we do at the year end for our clients, we reconcile the taxes and the income side of things. They might have other sources of income as well. We try to understand what is the effective tax rate for that person. Effective tax is, so if there's a difference in effective tax and what has been deducted for the individual, the difference is usually a refund. So they get some money back from the tax office because the employer has deducted additional tax on from their salary. There are certain reasons why they deduct a little bit more or less. Some employees, they have casual work or they work on shift basis. So their tax is determined based on their weekly hours. It changes accordingly, and then tax is decided based on the annual basis. So that's what the tax refund is. How you maximize the tax refunds, that's another thing. Yeah.
And it's important to understand that. I think, you see people coming to us all the time and say, hey, I've paid 40,000 in taxes and can I get 5,000 back or 10,000 back? And, more recently, I was hearing someone saying, hey, I've paid 80,000 in taxes. Can I get 50,000 back or 40,000 back? Tax return is an exercise where you have to pay the real amount of tax that the tax owes you, the tax office owes you. It's not so much about, stripping money away from the taxman, right? So it's important that, understanding the tax deduction or the tax planning as part of the overall equation is the key thing in reducing your effective tax rate down. Typically, that's what you're trying to do. You're trying to maximize your deduction so that you can get, slightly more, or you can, tailor it in such a way that, the scale tips towards you, rather than tipping it towards the taxman.
Pay the right amount of tax. That's what we're trying to achieve here. That's it. Yes.
Definitely. And so let's talk about deductions. And we are very focused in talking about deductions only in relation to investment properties. We are not going into a lot of detail around, generic deductions because, the list is a never-ending list. And so let's talk about the deductions that commonly people talk about, a day-to-day deduction that you would hear people talk about when it comes to property investing all the time.
Yeah, in a typical investment property scenario for an individual, the main deduction people talk about is repairs and maintenance. If they spend some money to maintain the property, they can claim that kind of deduction. There are certain obvious expenses they can claim: council rates, depreciation on the property if they are newish kind of property. Interest is the major one, interest on the loans. If the property is managed by a property manager, property management fees, of course, accountants' fees and tax agents' fees, the same thing pretty much.
So if we take a pause there and if we take a step back, when we talk about repairs and maintenance, there are things like, gardening, pest, cleaning, all of these are basically claimable, right? And,
whatever you need to spend to keep the property in shape, that's repairs and maintenance, and you can claim. There's certain difference between what is repairs and maintenance, what is innovation or renovation, basically. So you can't claim if you're replacing something in your house, you can't claim immediately. You can claim all that comes into depreciation. Yes, generally whatever repairs and maintenance you can claim.
And sometimes when people buy the properties, you would see that they would have to spend some money in order to make it tenantable. Are those classified as repairs and maintenance, or you would usually take that into capital investment as well?
That kind of expense is capital in nature. Okay, so you can claim those expenses, but you have to add them as a cost base, add to the cost base, and you claim when you sell the property. If the property is tenanted already and you're spending money on repairs and maintenance, then it is claimable while it is tenanted. But when you're making it ready for tenants and you spend some money, that's not immediately claimable. Okay, you can claim as a depreciation over the years there.
Sure. And if you talk about interest on loans, property management, I think these are very self-explanatory. Tax agent fees, accountant fees, again, they are very self-explanatory. People who are spending money in seeking tax advice, tax accountants advice, accounting advice, etc. All of these are, very self-explanatory. Let's talk about interest on loans slightly a bit more. When you talk about interest on loans, this is in relation to the properties that they are buying, right? The debt on that property. A lot of people tend to use their money from their principal place of residence and, refinance that money towards the interest. How does that work? Could you explain that as a bit more in relation to that? I know that portion of the loans are definitely tax deductible as well, but there is a slight nuance there, right?
That's right. So potentially, yes, you can claim interest on the loan you took out from your principal place of residence. The caveat is that ATO requires you to have a loan split into different loans, one especially for your principal place of residence, an additional loan which is used in investment property. So you need to keep those loans separate to able to claim the deduction for that particular portion of the loan. So it is deductible, but it has to be a separate loan. So you cannot. If it is a loan just combined with your principal place of residence loan, then you can't claim that portion of interest from that loan.
Sure, definitely. What else? Let's talk about insurances.
I mean, apart from the other expenses, you mean not from the investment side of things? Yeah, so it's been to increase the deduction side of things. If you general deductions, insurances, you can claim income protection insurance if you have income protection insurance under your personal name. Lots of people do have income protection insurance. You can potentially claim in your tax returns. Some insurance are combined together, which is a TPD and income protection. Only the income protection premium is deductible, not the TPD side of things. There's private health insurance. Lots of people ask question about the private health insurance. Are they deductible? Look, the private health insurance is not a deductible expense. Private health insurance is important when you have income more than 90,000 as an individual, 90,000 a year as an individual, because when your income goes above that level, you pay additional medical levy surcharge, either if your income is more than 90,000 a year as an individual or 180,000 a year as a family income. So if you don't have private health insurance and your income is above that threshold, you pay additional surcharge. So to avoid paying that surcharge, you should have that private health insurance. So it's not a deductible expense as such, but it helps you to reduce your tax liability.
Definitely. And super contributions, I think that is one thing. And let's go to the list of, deductions that are not generally discussed. And, let's kick it off with super contributions. I think a lot of people don't know and notice that super contributions are definitely tax deductible.
Yeah, previously, if you wanted to contribute into your super after tax, there was no deduction available personally in the tax. It was only deduction available through the employer. Recently, for 3-4 years, just before COVID, it was introduced that you could potentially claim. And if you have unused cap left for your concessional contribution, then you can top up your super and claim deduction in your personal tax returns. If the cash flow allows you, you should do that. So it will reduce. So your super fund pays only 15% tax. So rather than paying 30%, 40% tax, just pay 50% and contribute that much, or a smaller amount, larger amount, whatever you can, up to the capped amount, and you can reduce your taxes accordingly. Yes.
Definitely. And there is a slight interesting fact that a lot of people don't know about when it comes to super contributions, and that ties up into the capital gains side of things. And we were discussing this with one of our clients, where a client had a big bill for capital gains tax, where they had sold something and they were up for a capital gains tax. And so you provided a really awesome advice, and I would want to air it out in the podcast today and talk us through how does the two work. You can pay the super, reducing the capital gains. How does that work?
Yeah, so that comes under the planning again. So you need to plan ahead. If you're thinking about selling a property or some sort of investment assets in that particular financial year, then you should think about contributing into super. Why? Because when you're gonna sell a property, you would anticipate that there will be some capital gains. So with the capital gains, higher tax you have to pay. So to reduce that impact of paying high taxes, you can potentially contribute to your super, because in an unused cap, you can use it for last 5 years of unused cap. If you haven't used your cap, you can potentially contribute up to $50,000 into your super and claim deduction for it and reduce the capital gains amount, because the contribution you're making, it can offset your capital gains potentially. So yeah, so that's very, it comes down to the planning ahead. You need to, whenever you decide to sell, speak to your accountant and make sure that every possible deduction is available for you to reduce the capital gains, including the super contributions.
And what is the cap per year?
It's $27,500 per person. So if in 1 year, your employer contributed, let's say, $15,000, so you still have $12,500 left for that particular year. So you can go back 5 years back to accumulate all those unused cap and contribute in that particular way when you're selling the property and reduce the capital gains there.
And this is pretty interesting, right? If you have a capital gains of, say, $200,000, right? And, you would apply the discount rule of, say, 50%, and you have now a capital gains of $100,000 that you are exposed to on taxes. If you have between husband and wife a cap of, say, $50,000 each, then, you technically have to pay nothing, right? And so understand this, right? It's such a simple thing to do that, $100,000, even if you take an effective tax rate, you are paying $30,000 to the taxman pretty much right away on that capital gains, right?
You pay to taxman or to your super. What do you want?
Or you take that money to super and pay nothing to the taxman, right? Or 15% to the taxman, right? Yeah. And so out of, the 30,000 or 40,000, in some cases, I think, capital gains tax comes in at the premium rate, right? Because they are coming in over and above, your total, whatever you're earning. And so in this particular client's perspective,
it was 45% tax rate. So you save potentially 30% tax if you contribute to your super. The only thing which people are scared of, that once the money is in super, they can't take that money out quickly. It is stuck there. But yeah, you have to save some taxes, but your retirement savings are going up at the same time.
Definitely. And there is a lot that you can do with super, right? People who are listening and tuning to us for the first time, they should definitely go back and listen to our SMSF investing podcast. We've talked about, how to set up, super renovations or self-managed super funds, and how can you use that towards the advantage of, investing via property. But of course, people naturally think that this money is getting stuck and I would only see this past 60 or whatever that, retirement age looks like. That doesn't necessarily needs to be, right? So coming back to the topic, let's talk about, you were talking about the deductions that are not generally discussed. We've talked about superannuation or super contributions. What else?
Yeah, I mean, from investment property perspective, lots of people don't think about land taxes. Land tax they pay on the property, it is tax deductible. Body corporate fees, it is deductible as well. Borrowing expense is one of the major one. People don't realize that they can claim borrowing expenses as a deduction for their investment property. Though it is over 5 years, but it involves the cost of establishment of loan facility, discharge fee, broker fee, loan admin fees, valuation fees, and LMI as well, loan mortgage insurance. It's part of your borrowing expense. So you can claim those expenses for your rental property.
Borrowing expenses are an interesting one, right? I think people don't tend to see borrowing expenses because when the loan settles, these are usually hidden on their statements or bank statements. They don't even show up on their bank accounts because, the bank would usually offset this against your loan and it would be a single number that would usually show up. And so it's important that, you hold on to those statements, especially when you're talking about lender's mortgage insurance, establishment fees, broker fees, valuation fees. All of these fees do amount to a big amount of money. These are not small chunks, right? Especially when you are buying properties at, say, 88% LVR or 90% LVR.
That's true. So it is somewhat hidden. So it is, if you have a good accountant, they can ask for settlement statement and put that information in the tax return.
Definitely. What about home office expenses? I know there is a lot of contention around this. And when you mention this to a tax agent, it'd be like, I'm not sure whether you should be claiming any home office expenses. Talk us through about there.
Yeah, so it is hangover deduction from COVID areas, COVID times when people used to work from home, and ATO allowed people to claim lots of home office expenses. There were different methods, and people is still trying to claim home office expense, though it is still possible, but it's not as much as you would do it previously. But yeah, if you're still working from home, you claim certain expenses, including some occupancy costs of your house, interest expense and rates and other utilities and things like that. You need to work out the basis of deduction, but yeah, you can still claim home office expenses as long as you're working from home, either part-time, full-time, doesn't really matter. You can still claim those expenses.
In today's time, you would see that, an average Australian is at least working 2 days or 3 days a week from home, right? So there is a lot of stuff that they can claim, especially like when you talk about running property as a business, you could be exposing yourself to a lot of this money that you're spending on. You might have a full-scale office that you might have created. I know developers tend to do that a lot where, they would have, their garage converted into a home office potentially, right? And so there is that's leaving money on the table if you're not considering some of these expensive as well.
That's right. That's true.
Now, I understand that, when you talk about property investing, people tend to, set up trusts and, set up companies and discretionary trusts and family, all of these things, there's a lot of deduction that comes together with that as well, isn't it? That people don't really think about.
Especially the setup costs of setting up to those kind of structures. They usually don't tend to claim those expenses because the trust is not established, for example, as yet. But you can claim these kind of expenses as establishment cost later on. Again, they're called sunk cost or black hole expenditure, but you can claim them in future over 5 years or whatever. Yeah, there's a way to claim that kind of expense. There are legal fees, legal expenses involved in managing all the finance side of things or documentation side of things. You can claim those expenses. Agents' fees, buyer's agents, seller's agents' fees, or seller's agents part of the cost base anyway. So buyer's agent fee, you can claim as long as connected to your portfolio investment advice. You can claim that as a deduction. If it is just straightforward, just one buyer's agent fee related to one property, then it goes into as a capital expense, not as a normal deduction. But yeah, there are certain expenses you can claim in your trust as well, which you should be keeping records of. Yeah.
Sure. Let's talk about the tools and equipments and the subscriptions that people tend to get to these days as well. People tend to spend a lot of money in that sort of space. What are the rulings around there?
Yeah. So with regards to tools of trade, whatever you spend in order to earn your income, you spend money on your tools in the IT-based client, for example, the IT-based work environment where you're working from home and you need laptop to work. That becomes your tools of trade. So you can claim deduction if you need to buy a new laptop to work on your job. Then you can claim those kind of expenses. Mobile phones, you can claim iPads, these sort of things you need to work. And then, yeah, you can potentially claim those expenses. Sometimes you subscribe to different services, for example, Zoom or Zoom meeting, because not everybody is on Teams, or you need to subscribe to other Microsoft subscription of different kind. Then you can pay for those subscriptions. You can claim for those subscriptions. There are other, you're subscribing to a professional magazine or journal or something where you can claim expenses for those. If you are part of an organization, a member of any organization, you can claim the membership fee for the particular organization as well.
People really try to push the boundaries here, isn't it? They would try to push in Netflix and Amazon Prime and Disney and all of these things, and they would try to claim some of these things as well.
Because they say they're working from home, they need to relax as well. So I've seen that people claiming coffee machines and stuff like that, they're buying in their homes and then trying to claim that it's our dedicated area of work here as well.
Yes. And so a lot of this is gray area, by the way. So I'm not saying yes or no, of course.
Exactly. So it depends on case by case basis. If it is relevant to earn your income, yes, there has to be nexus between your work-related deductions and your income, basically.
And a lot of people, if you talk about deductions and claiming and non-claiming as well, there is a lot of investment property education that people try to push and claim. And there is a very hard line that tax office is drawn, isn't it? In relation to travel and investment property education, that, you can't claim any of these in taxes.
Right. That's right. I mean, lots of people ask you to come to those courses because they are claimable as a deduction. And I'm sorry to say, but it's not straightforward. It's not that straightforward. You can't claim those deductions. It's not possible. I mean, it has to be connected to some sort of income earning capacity. How does it make it earn income? And so if it is not connected to any income earning capacity, then you can't claim. Simple as that. Okay. Again, there's a way, or if it is connected to some sort of income earning capacity, that's possible. But the simple answer is no. You can't claim these sort of deductions straightforward.
Yeah, gone are those days where you could travel interstate, visiting your property and claim all of those deductions.
That's already gone. Yeah, they have removed that deduction. It used to be there that if you wanted to visit your property in Queensland, you stayed there for 2 days and then claim deduction for it. It's not available anymore. They have removed that deduction. The education part, they removed that deduction. So yeah, they're tightening those rules slowly. So yeah.
But they have left one deduction, which is the funny one, right? You can still go out and visit your taxman or your tax agent in any state and still claim that deduction. So
it depends. Yeah, I mean, if it is specifically to get the financial or tax advice, yes, you can potentially. Yes, of course. Yeah, yeah. So you can claim the travel to your tax agent or accountant. You can claim that as a deduction as long as it connects to the particular advice you're seeking from your professional.
So a lot of our clients in Sydney or a lot of our clients in Queensland, Perth, I'm happy to see, or we are happy to see you whenever you want. Just make sure that, you're seeking advice from Sohail and not from me. Again, look, jokes apart, you have to be creative around some of these things. As Sohail did mention, that you have to find that nexus in order to making sure that, you're not being overly creative, but you're not leaving money on the table as well. And the final thing that a lot of people don't tend to care about is the GST side of things, right? A lot of people tend to set up a lot of these things in trust. And so why is claiming this GST is important? And, what's the value benefit there? So if you want to talk a bit about that.
Lots of people, if they are in renovating or they bought property where they need to some work done, especially in business structure. So if they register, because if they register for GST, they can claim that GST back. It impacts on cash flow. It's money available for you. Why not take it back? Because on residential rent, you don't pay GST on it, but any expense you spend money on the property itself, you can claim the GST back. It should be worthwhile enough GST to claim back, say, because you have to spend money on GST registration and lodging bills and stuff like that. People, if they are in a construction, if they are not developing at this stage, but they are doing some small constructions, adding bedroom or something like that, or adding bathroom there, so you can potentially claim GST on those expenses, especially if they are in a trust environment. They can do outside the trust environment, but it becomes complicated if it is under individual name, because that brings other complexities. But as long as if you have a business structure, GST can be helpful. But of course, again, case by case basis, maybe not necessary for everyone. But
the important sort of caveat here, or should I say, the important understanding here that we want to call out is it's not always only for the trust side of things, right? You can claim GST in your own personal capacity as well. If you're building a house to keep, you've paid GST, you have to pay GST on the sale, then, or you're holding it for a long-term basis, you can, set yourself up in such a way that you can use your sole trader ABN to, claim some of these things, even though the house might not be in a trust capacity or in a discretionary trust capacity. So some of those things needs to be just called out. Let's talk about the PAYG withholding variation. This is the most important topic. And I think it's very relevant in today's time as well, because, a lot of people are feeling, cash burn or cash flow burn in relation to the inflation that are hitting them or the higher interest rates that are hitting them. Talk us through about this PAYG variation on pay-as-you-go variation, and how does that help in managing the cash flow?
Yeah, as you understand that there's a set rate of tax deduction at source from your employment. Okay, so but you know that you have a negatively geared property. You know that you expect some refund at year end. Rather than getting that refund at year end, you can reduce your tax rate during the year and get that refund slowly in your pocket from your employer, rather than paying the tax and claim back in the year end. So there's a method which is called PAYG withholding variation application. You can submit that application to tax office and tell them that my expected tax liability for the full year is going to be that much. On that basis, they will approve the application and reduced rate will be applicable. They will issue a certificate to you, you will show it to your employer, and employer will reduce the tax rate for you and then put that. So you will, instead of getting the full refund at the year end, $10,000 you're expecting, you should get $1,000 each month, for example, additional cash. So that will help you in terms of managing expenses on month-to-month basis, rather than just wait for the whole year and then spend. You see the $10,000, you spend something on something else. You just use that money to manage your cash flow during the year. So that's very important, and it is very easy to apply. I mean, nowadays everything is through MyGov. If you log into MyGov, and there's an application, you search for it, PAYG withholding variation. Once it is submitted, and you will approve it, and then you provide that information to your employer.
And for people who have a lot of houses and, they are managing a decent sort of portfolio, and of course, if you haven't set up your portfolio properly and it's causing you cash strain, then this is one of the perfect strategies to basically engage, where you are reducing your effective tax rate to an extent that is going to be at the end of the year, so that you can save the cash flow now to manage it, in a slightly better way, rather than, waiting for the year end and, getting that money back. I think there are cutoffs in relation to the applications as well, isn't it?
I mean, yeah, usually you need to do it before a certain period. I think it's May or June, for the next financial year. So you need to apply for variation by 30th of April. I don't have the number date in my head, but yeah, so you need to be before 1st of July. You need to apply. I think that's May or June, something like that. And then once it is approved, you provide, and from the July onwards, that new rate will be applicable for you. So,
and you can do it during the year as well, isn't it?
Yeah, you can do that during the year as well.
Yes, so a lot of people think that it only happens once a year, and once you've missed the boat, that it cannot happen. I think the important thing is, while July is already started and you're already in August, you can actually do it for the future periods as well. It applies all the way through to, June year end as well.
Yeah, it is possible to apply during the year as well. Yes.
Perfect. Awesome. Any parting ways in order to maximize the tax returns on investment properties?
Just make sure that don't miss out on any deductions. Keep a record of everything you spend, and if it is money spent to earn the income, make sure you tell the tax agent or your accountant about it. If you forget about it and they don't ask you, you're going to miss out on those deductions. Okay, so you should have a accountant who is switched on already, and you should be able to provide those evidence. Evidence is important to claim any deduction. ATO is very strict nowadays on evidence. Even some deductions which did not require evidence before, you need to make sure you have evidence or substantiation documents to claim any deductions. That's very important.
And it's important. I think that's a wonderful closure to the episode that we are doing today. There are certain apps that you can use to basically, keep a lot of this evidence. You don't need to have these physical receipts anymore. One of the ways that I do is take pictures of everything that I think and pack it into various different folders or put it on Dropbox or Google Drive or anything like that. And so it's important that, you get into a better discipline in, keeping all of this evidence with you so that it makes the life easier, not only for yourself, but also the taxman at the very end.
That's true. Yeah.
Thank you for listening to us today. If you have any questions, comments, feedback, please drop it into the comments below, or, subscribe to our Help Me Buy Property podcast. Keep smiling, take care, keep investing. This is Moxin, Sohail checking out. Adios.
Thanks. Bye.